Good morning, everyone. Welcome to Stock Market Today. It's Thursday, July 23rd, 2020. This is your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for that free email. I get a lot of the content for that show from that email, and it also gives you some stock ideas to consider upon further work. And that hits your inbox every trading day before the market opens. So U.S. equities were higher Wednesday, with investors appearing to price in further stimulus in the U.S. on the heels of action out of the EU. Leadership was actually in the bond proxies. REITs and utilities outperformed, while energy and financials lagged the broader tape. Treasuries were a bit weaker at the front end of the curve and stronger at the back end. The dollar was stronger against the yen, but softer against the euro and sterling once again. Gold up 1.2%. Silver also extended a big rally. We'll take a look at that chart. WTI crude was little changed. As we get to the desk this morning, futures are up about 40 basis points after closing higher yesterday for a fourth consecutive day for the S&P 500. Asian markets mixed overnight. European markets seeing some good gains. Treasuries are mixed, curve flattening, dollar extending its recent underperformance against the euro, flat against the yen. Gold is up 80 basis points, adding up. WTI crude is up nearly 1% as we dive into a chart that is just grinding higher, right? Not a ton to say here away from what we've been saying, right? The path of least resistance remains up. The uptrend off of the March 23rd lows is intact. The door is open to the February highs. I don't know if we're going to go there in a straight line. We certainly do have to start to think about this gap here a little bit and the fact that we're overbought based on the indicator. Chaikin money flow, however, is bullish. So big picture trend perspective, the song remains the same, and I keep saying that because, well, it's true. 50-day moving average rising and extending above the 200-day moving average. Solid support down below 3,000 to 3,100. 2850, 2950 below that, but I think there'll be a lot of work to do to get through support here in the near term. Resistance 3,300 to 3,400 kind of lines up with the gap, if you will. The gap here, the high, the gap kind of make up the resistance point at this level. But the highs are in play as support has continued to hold on these pullbacks, and we are grinding higher. The breakout now actually increases the odds, right? And remember, it's an odds game, and those odds shift every day. Increases the odds, in my opinion, that we're going to the February highs. So that's the framework for the S&P 500, right? I like to think of the S&P 500 as a trigger. What are stocks as an asset class doing? Well, they're going higher. All right, well, now where do we want to be positioned? Well, that's the game. Growth, value, small, large, tech, healthcare, right? That's the game. I really want people to get away from this. Oh, I'm just looking at the S&P. That's great. But under the surface of the S&P, if you're not in the right areas, it doesn't matter what the S&P is doing, right? If you've been in energy for the past 2 years, your portfolio is a mess, right? Be in the areas that are outperforming. Let's talk about our market in a minute. Stocks grind higher, led by bond proxies. Breadth metrics continue to improve. We talk about breadth every Thursday. Too far, too fast for silver, in my opinion. I still am on this inflation theme. I think a pullback will give you an opportunity in silver. We'll look at that chart. China tech, that's now oversold based on our work, our indicator here at Chaikin Analytics. I'm highlighting it in my note today because I do think that there is also this theme of we're starting to see some outperformance outside of the U.S. It's largely centered on growth. I've talked about funds like EFG. I've talked about China tech in the past. So let's take a look at that one a little bit later on in the show as well. And as I said, futures point to a higher open here today. Major indices from a power bar perspective, the power bars just keep strengthening. 9 to 5, bulls to bears for the Dow after adding 63 basis points. S&P 500 up 0.5%, 151 to 66. NASDAQ slight underperformer on the day, 45 to 6, bulls to bears there. Actually, one of the rare days where we see small caps outperform on an up day for the markets. Right, the trend of late has been small caps leading on up days. Yesterday it underperformed on an up day. So that's kind of, I don't know what to make of it. I really probably don't make anything of it. I continue to favor large over small unless you're focused on the growth theme, in which case I like small growth as well. 618 to 280 bulls to bears there. Bonds uptick, sending yields lower. 10-year under 60 basis points at one point yesterday. And utilities were your big leadership group, up 1.5%, 11 to 1 bulls to bears for the ratio there. Let's hit our stocks of the day now. Stocks of the day, what I did today was, because we're in the heart of earnings season, is I have a screen that I've created that I call earnings leaders. And I look at, this is one of the rare instances where I drill down on individual factors within our model, obviously all related to growth. So I'm looking for our factors having earnings growth as bullish, earnings trend as bullish, and also earnings consistency as bullish. If those three factors are in place, I then drill down strong money flow, strong relative strength. And I did this on the Russell 3000 to give me kind of a bigger view. So it returned 39 names. Not all of, I mean, some of them may have reported, some of them, may have yet to report, some may be off quarter. This is not go out and buy these names because I think they're going to crush earnings. These are just names that are bullish based on our main earnings factors that also have strong money flow, strong relative strength. The tactical setup might not be there from an overbought, oversold perspective, but I think if you're looking for quality companies, if you're looking for companies that put up solid numbers such that they earn a bullish rating for those factors in our model, this is a pretty good screen, right? And you'll see some of the big ones on there, right? Microsoft, I mean, their numbers were fine last night. It became an expectations game with the stock down 2% here this morning. But you see some solid names on here: Google, Lennar, Adobe. So this is, to me, this is your quality screen. This is your screen where you say, I'm interested in the names that exhibit some quality when it comes to earnings. So screenshot this. If you get my notes every day, it's in there as well. Let's look at the sector tracker now, movement of the last 5 days. Utilities at the top of the list after that big move. Actually, utilities have had a strong few days. I'm watching their relative strength very closely, actually. Materials, right? That's the cyclical bucket that we like. Healthcare, we talked about it earlier this week, bouncing off of relative support. Discretionary, Amazon in this case, different from the retail that we looked at yesterday. Middle of the road, tech, industrial staples, energy, comms, fins, and REITs, the bottom of the list. All groups higher over the past 5 days. The S&P 500 just logged its 4th straight day of gains. So the trend is up. Our industry in focus, semi-services. You know how I feel about semiconductors. I pay close attention to them. Over the past 6 months, this group has outperformed the S&P 500 by 14%. Power bar ratio, which measures future potential, is very strong, with more bullish than bearish stocks. 10 to 2 bulls to bears for this group, and it's currently ranked number 7 of 21 subsectors, and moved up 4 slots over the past week. So some names there that might be of interest. First Solar gets the added tailwind of being exposed to the super hot, pun intended, solar space. Diodes, DIOD, and Smart Global Holdings, SGH, all with very bullish Chaikin power gauge ratings, as holdings of a ETF that looks like this. We're at the highs. Very bullish stock, strong trend, strong industry group, right? Above the rising long-term trend line, solid outperformance, money flow, right? It's all there. You see the breakout through 150. I think, when semis are outperforming, that's generally a good landscape for the market in general. So just something to be aware of. I know a lot of people want to kind of anchor to the bearish narrative. Don't anchor to any narrative. Follow price, follow trends, follow your key signals. Play the odds game. Recognize that nothing's 100%. So let your risk management process take over should the bearish narrative begin to play out, rather than guess when it's going to play out. That's at least my view. A lot of people have different styles, but to me, that's the way I come at the markets. Let's look at what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers. HCA, their earnings announcement sent that stock higher by nearly 12%. NVR, some existing home sales data sent that stock up by 10% plus. AMD, a breakout to new highs, up 8.5%, part of that semis group. BBY, it's Best Buy, gave a sales update, which sent the stock higher by 7.84%. Nothing company specific on UHS, which is a bullish rated stock. That was up 5.8% yesterday on the day. On the loser side of the board, there's FE, First Energy again, down 20%. There's clearly something going on there. Bribery allegations, deep in the weeds, probably worth just staying away from. Northern Trust reported earnings. That stock lower by 5.25%. United Airlines earnings down out yesterday. Stock down 4.25%. Said until there's a vaccine, their revenues are likely to be half of what they were. Kohl's caught a downgrade at UBS, down nearly 4%. Wynn said that they were going to begin furloughing some of their employees. Wynn is a very bearish stock here, and it was down 3.9% yesterday. Let's dig into the charts now. Breadth metrics continue to improve. Now, the divergence is still in play, but divergences are a warning sign, right? They need to be confirmed by something happening in price, right? Go back to early Feb, right? The divergence was in play, but it was the breakdown in price that gave it confirmation, right? So we want to be aware of it, but continue to follow price. In the meantime, the metrics are strengthening, right? Percentage of stocks above their 200-day back above 50%. Percentage of stocks above their 50-day above 80%. The percentage of stocks above their 20-day moving averages, which you can see in my note, is hovering around 80%. And the advanced decline line for the S&P 500 has broken top side to new highs, right? So the breadth is there. That's why you follow price. The breadth is there. The divergence we're watching, right? But the divergence is a wake-up call. Price is your signal. Okay? That's the way I look at divergences. Whether I'm looking at them as, momentum divergences on RSI or any other indicator, they need to be confirmed. They're your wake-up. They're your clue that if you don't have a risk management process, you should probably think about one, because then you'll get your trigger, your risk management. If the divergences are confirmed, your trigger, your risk management process takes over, right? Stocks started breaking down. I mean, by early March, I would argue that most people's trading type risk management triggers should have kicked in, depending on your time frame, obviously. It's not about calling the top and calling the bottom. It's about letting risk management take you out, letting you know that the trend is now over. So that's my view. That's how I come at it, depending on how you're kind of setting up your portfolio. But manage risk for your time frame. I say it time and time again. The calls that I host with our clients at Shaken Analytics, I mean, I pound risk management into the table, pound it into the table. I will argue that it is as important as your stock selection process. No two ways about it. There's no excuse for sitting with a massive loser. Too far, too fast for silver? Probably. We started talking about silver back in early July in our notes. We get the breakout and then the pop. Nice trade. Don't necessarily think you want to chase it here. Massively overbought based on the 13-period CCI. Look at that scooter. I mean, that's great. The relative performance is there. No two ways about that. The question is, do you want to chase it? And I don't think so. I think you want to look for pullbacks into kind of this 19 to 20 area, maybe even down to 18.5. I mean, that would be the ideal. To me, that's a great setup, right? I like that setup. Breakout, retest, go. I love those setups. That's what I'd be looking for in silver to kind of open if you're not there. If you're already there, move up your stop and enjoy the ride. Finally, I said we'd look at China Tech, CQQQ, the Invesco China Tech ETF. It's oversold by our overbought, oversold indicator at Shaken Analytics, above the 50, above the 200-day, holding relative support against the S&P 500, right? So this is what I'm talking about when I said we're starting to see some percolation, if you will, outside of the U.S. I think this is an interesting theme that folks should have some exposure to. Take us for a test drive. I'll be back tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.